Welcome again to my accounting tutorial channel where I translate technical accounting topics to a storytelling version sort of. So, in the past episodes, we talked about these 12 possible questions that might be asked of you in your tests and examinations related to loans receivable accounting. Okay? So in this video, we are to finish all the questions. So, let's start with question number 13. Question number 13 is, what is the interest income amounts after impairment? So, the process of getting the amount of interest income is practically the same with what we did in question number 4. So, we just have to get the difference of the after interest amounts minus the before interest payments. Like in this problem, if we wanted to get the interest income for year 3, we need to get the difference of this 3,587,444 and this 3,217,439. And that's again 370,005. That's it. But there are twists. So if we're going to talk about the general approach in the expected credit loss model, because the interest income after impairment is computed differently in stage 3 and stage 2 and stage 1. So, if you remembered, in stage 3, the interest income is to be based on the net carrying amount. But on stage 2 and stage 1, the interest income is to be based on the gross carrying amount. But aside from that, there are no other twists. Okay? Question number 14. What are the receivable balances after the impairment? In general, you can just multiply 1 plus interest rate with the balance after impairment, just like this. And after that, deduct whatever payments the debtor is giving during the year, and that will be equals the receivable balance already. Although, here, since the debtor only promised to pay at the end, so there are no deductions at the end of year 3. And that's it. Okay? However, if you wanted to be safe, especially if the stages of general approach on expected credit loss model is already involved, then you can get the net carrying amount of the receivable. So that's again gross receivable minus allowance for impairment losses. And then add the interest income computed, but be careful where to multiply your effective rate, okay? Again, if stage 1 and stage 2, you multiply the effective rate with the gross amount. But on stage 3, you need to multiply the rate on the net carrying amount. Okay? I'll repeat that as many times as possible. Now, after adding the interest income that you computed, you need to deduct the payments of the debtor during the period, like interest payments or other payments. So in here again, no payments were received in year 3, which is why only the interest income was considered in the valuation of the receivable at the end of year 3. Question number 15. What is the amount of allowance for impairment loss account? Like, what is the balance of this account, allowance for impairment loss, if ever you're going to use it? Okay? Well, let's assume that you are asked, how much is the remaining allowance for impairment loss in this illustrative problem at the end of year 3? And also, let's assume that instead of using loans receivable account as credit here and loans receivable account as debit here, let's assume that you use the account allowance for impairment loss. Okay? Of course, that's 1,654,970 at the very beginning, but it will be decreased by 370,005. And your answer will be 1,284,965. So that's the balance at the end of year 3 of the allowance of impairment loss. Okay? But if you are asked about year 4, then you just have to deduct it further by 412,556, and the remaining balance will become 872,409. And that's it. So question number 16, which is the second to the last question, which is what are the current and the non-current portion of the receivable balance after the impairment? So that's practically the same with the question number 8 and question number 9, which is if after 12 months the receivable did not decrease, then all of the balance will be considered non-current. But if it did decrease, then the decrease is already the current portion and the remaining balance after 12 months is considered non-current. So that's question number 16. So, welcome to the last question, which is, what is the gain on reversal of impairment? Guys, let me tell you this. There are times that the debtor's financial condition can recover. Like, let's go back to this example. So, in this problem, at the end of year 2, the loans receivable was impaired, right? However, at the end of year 3, let's assume that the debtor recovered from financial difficulty slightly. Okay? And the problem said that BBM, the debtor, can already pay 5 million at the end of year 4, which is 1 million higher than the original 4 million promised. Okay? So, what will happen? First is you need to get the present value of the new promise, which is paying 5 million, by multiplying it with 1 plus I raised to the power of negative 1. And then you need to compare that with the current year 3 balance, which is again 3,587,444. Okay? Of course, the new present value based on the 5 million will be greater, right? So, the difference of the two, the 3,587,444 and the new present value, will be debited to loans receivable or allowance for impairment account. And of course, the credit is gain on reversal of impairment. And that's it. So that's it for all the possible questions in loans receivable accounting. And also, this is the end of accounting for loans, for both loans payable and loans receivable. So the next videos will already be dedicated to the notes payable and notes receivable topic. So let's end this video, and if you have learned, please click like, subscribe, and hit the notification bell